we're on to some news. Some news from Adobe. Steve, what's been happening over there?
So it was Adobe's earnings today, and they were down 17%. So you'd think these earnings were atrocious, but they were not. In fact, if anything, these earnings were a flex on Adobe's forecasting abilities, because almost everything was like a tick box exercise. You're going down it, going, they forecast that. Yeah, they forecast that. Yeah, that was exactly as they forecasted. So what the hell was happening? You know what I mean? I was looking at these thinking, oh, these are unremarkable earnings in that they are almost routine. So why is the stock down 17%? I had a good little scribble around, and they announced at the end of it that they're acquiring a company called Figma. Figma is an interesting looking company. It's a competitor for, I guess the nearest competitor is with Adobe's XD product. And we'll talk about that a little bit later and what it is, because that's not important at the moment. But so this is a $20 billion deal, Steve. It's stock and cash. They're expecting to be 50-50. I don't think this is a great deal. I mean, Adobe is already cut in half over the last sort of 6 months. I don't know why they're wanting to now put the stock forward for something. I mean, their stock isn't cheap, but it was a lot less cheap only a few months ago. So I've got some sort of stats for you. Its TAM, it advertises it has been about $16.5 billion. It's growing pretty quickly, about a 50% clip. It's a private company, so they don't get all the kind of fanfare that a public company does. So gross margins are above 90%. Its dollar-based net retention is over 150%. It's actually already got positive operating cash flows, but $20 billion is like 33 and a third times sales, Steve. Last year they raised $200 million at a $10 billion valuation. That was last year when valuations were still wild. This is double that. So this is strange. Adobe want to run this like a subsidiary. They're letting the CEO stay on. They're going to run it as like a semi-independent subsidiary, let them develop themselves. It's not a hostile deal in that regard. The Figma CEO actually sees Adobe as a really good way for them to get sort of an established conglomerate looking after them, offering additional leadership and growth when they need it. So I just looking at this deal, I just think Adobe is completely caved in. They've looked at this deal and they think Figma is just eating into their market share. And I think this looks awful to me. I mean, I just can't see how this passes. Adobe has a competitor that's eating into their market share and they've just took it out. I just don't think this gets through any kind of anti-competitive. And for anybody thinking, oh, cool, I'll just buy Adobe and when this deal falls through, I'll get my 16% back. Well, I mean, I'm not so certain that's going to happen, because Adobe are literally telling you here that Figma's product is way better than theirs. Steve, thoughts?
Yeah, really interesting. Your point about the combination of cash and stock. I'm guessing Adobe didn't want to do that for the reason that you're saying. Their stock is currently trading at a lower price than it was a year ago, say. And in general, I don't like companies using stock to buy things anyway, if they can help it. I don't mind it if the stock is massively overvalued, but I don't think Adobe's is at the moment. The immediate thought that occurred to me is that that's going to show up as a $10 billion dilution in that case, which means that it will automatically just do one more thing to repel all the value investors who like putting numbers into spreadsheets and think if the share count is going up, no thank you. They may be right on this occasion for what it's worth. They may well be justified in thinking that this won't make revenues go up by enough in a certain way. It's 30-something times revenues, you said, okay, and 90% margin, so actually 30-something times growth, maybe 40-something times gross profits, which isn't too bad. But, gosh, it's a lot to spend. I mean, you would expect, and you normally do see, the acquiring company's share price going down as they make an acquisition for a couple of reasons. One is that they're putting out money now and it's on them to prove it that it's worth the money that they're spending on it. And that's fair enough. The thing you know about is usually cash and the value of your stock. The thing that you don't know is what the future earnings look like. So you're trading a known for an unknown, and usually you're trading a sizable quantity of known for a different kind of unsure quantity of unknown. We'll see how that goes, I guess, for Adobe and Figma. The other reason is that will show up on their balance sheet, and just a feature of things that we've seen lately when you think of Teladoc and Amazon, and I'm not saying these are badly run companies, either of them, decide for yourself on that. It is the case that when you start finding that you've overpaid for something, you end up with things getting impaired quite a lot, and your stock price tends to get hammered when that happens as well. We've seen that happen to both Amazon and Teladoc fairly recently for what seems to be that as the main kind of cause of these things. Teladoc's merger with Livongo appears to be, I think, probably got to call it overpriced in this situation. I wonder whether we'll see something similar happen to Adobe if they find themselves having to effectively write down the value of some of the assets they've acquired here faster than depreciation levels.
Well, they're going to have to do that if it doesn't perform, doesn't it? I mean, we're talking about a company that's growing at 50% privately, which is a lot. And Figma is attacked Adobe in a really smart way. It's given its product away to students for free. Students get used to using Figma. They leave, they graduate, they go to get a job. The job puts Adobe XD in front of them, and they say, "Hey, look, this Figma thing is so much better than this," and it's and eventually a company tries it and then eventually they swap to it, I guess, is what Figma's guessing here. I mean, they're doing 600 million in revenue at the moment on an annual run rate, so this isn't a small company. This isn't I guess it's still small in terms of a 20 billion valuation. I mean, this was peak COVID highs kind of levels of valuation. But I mean, I had a really good look around Figma today because I must admit I'd not heard anything of it, and it's essentially a design collaboration tool. They've got some really high up clients. They ran the whole Biden campaign for president, was all designed and delivered within Figma, and plenty of other stuff as well. But part of me just thinks, why can't this be like Salesforce Ventures? Salesforce is really good at picking up little bits of these companies and buying them along the way. Why is Adobe buying it all now at such an elevated price? I think this is a lot of money, Steve. I don't understand why they've not been able to get this at 10 billion. I don't understand why. I mean, are we really saying from last year to today this company has doubled its valuation on only 50% top line growth? They must see something remarkable there. There must be something there they think is exceptional, and it might be that this CEO is a visionary that they think probably, I mean, Narayan is getting quite old at Adobe. Perhaps they see him, the 20 billion is that he eventually becomes the successor who pushes the Adobe product on. Maybe that's what they're paying for, but they've not given you enough information, and the market has looked at this and it doesn't like it.
Yeah, I'm not sure about that particular. I mean, so when I'm thinking what justifies you paying that kind of revenue multiple or something like that, the answer to me has to be we can make this company better somehow. We can get more cash out of this company that it can produce by itself. And that's not crazy, because this isn't like a Berkshire Hathaway type thing where this is a business that has nothing to do with any of their other businesses, but it's great, so we can go and buy it. This is a business that is, as you point out, not just adjacent to Adobe, but in the same place as Adobe, with at least one of their products, which was XD, you mentioned. So I get the impression they must be thinking there's some sort of synergy they can get out of these things, or that together they're worth more than they are individually. So something over and above the sum of the parts. What that would be, I don't know. But this does remind me, this whole thing actually reminds me that there's a circle of competence that I have and a circle of competence that I haven't. And Adobe is kind of comprehensible. I get how the business works in a sort of fairly basic way. Did I know anything about its kind of competitors? No, this is the first time I've heard Figma. We've talked about Adobe on this show before. We've discussed its kind of valuation and so on and so forth. I'd heard of DaVinci, but only through kind of you and Paul as a kind of competitor elsewhere on that sort of business. But yeah, really interesting, Figma as a kind of organisation, and this is a story too.
It is, yeah. Just looking through the other things as well. So at the moment they've got Spotify as a client as well. So they're already attracting some pretty important companies really into the fold. I mean, part of me thinks you should have let them go public. Let them go public into this. Encourage them to go public into this market, and then buy them hostile. But looking at their metrics, Steve, just if people wanted a comparison for a techie sort of company, these metrics are very, very close to somebody like Monday.com, even the gross profits and things like that. And Monday.com, it had a lot of fanfare when it came to the market, but it's since collapsed massively since then. Monday.com is now about 6 billion in terms of its market cap. It actually came public around this kind of price, but doubled. So it went up to 12 sort of billion, around that kind of amount. So that's kind of the one I would point people towards. What's happened to these sorts of companies with these sorts of metrics valuation over the last year? They certainly haven't doubled.
Yeah, that's an interesting one. Your point about let them IPO and then take them over hostile reminded me of a story I was looking at back over this side, which has nothing to do with Adobe or Figma or any of these things, but I was thinking about the Unilever Glaxo thing. So Unilever tried to buy Glaxo's consumer products division off them for a number I now forget, might be about 40 billion or so. Glaxo said, no, thank you, it's worth more than that, we'll IPO it, and got less for it. And a lot of people pointed out, quite rightly I think, that means that Glaxo made the wrong decision not to sell that. Basically, they could have got more for it by selling it to Unilever. I think there's an underrated point to be made here that says that Unilever made a bad decision trying to buy it because they were offering way too much money. The fact that Glaxo weren't switched on enough to take it doesn't mean it was a good offer and that they should have sold it to them. That just strikes me as two sets of management both making the wrong decision here. One trying to buy something and the other refusing to let them do it. At least Figma...
Two wrongs don't make a right.
No, at least Figma has... well, I don't know whether the thought crossed their mind, to be honest, but had the good sense to not try and IPO themselves into what is a market that is not currently particularly nurturing for IPOs. But, yeah,